Welcome back to Investment 360. The Oasis General Equity Fund has outperformed the average domestic general equity fund by 30% over the last 10 years. Now, the secret of the fund's success has been to perform better in bear months than its peers. In an average down month, the fund has only declined 2.5%. That's versus 3% for the average domestic equity fund. Joining us from Cape Town, Ebrahim, founder, CEO and portfolio manager at Oasis Asset Management. Adam, thanks so much for your time. So let's kick off with the defensive nature of the fund. How do you manage that downside and how do you manage the portfolio during those downturns?
Samantha, good evening. I think it's important. Oasis's philosophy is to ensure we buy great companies at attractive prices, in giving us downside protection. So we buy companies when they're out of favor, and when people dislike those companies, so we buy them really cheaply, below intrinsic value. So that allows us to grow the income stream, grow the asset base, grow the value with a lot of downside protection. So typically what would happen is when the going's good, some of the fast runners, the hares, will be faster than us. But when the going is tough, Oasis really performs, and this goes in, month out, quarter in, quarter out, day in, day out, year in, year out. In tough times, that's when Oasis, on average, would have approximately 60% downside to 70% downside and approximately 90% upside through our bottom-up stock picking. So we really focus on economic value and buy the greatest companies, and we don't get involved in fads. When things go up, we would sell them, and when things are depressed, we would buy them. So we take a long-term view, and we really like to buy great companies cheaply.
Adam, if I'm getting your investment philosophy right here, it's very value-oriented, and you're really looking to buy the good quality companies when there's lots of doom and gloom around them. So if that's the case, I would suspect that some of the platinum companies would be coming onto your radar at the moment.
I think if you look at, we've bought some low-cost mining companies, and we most probably have the best platinum opportunity in a company called Pallinghurst. Pallinghurst is a company that is diverse. It's run by Brian Gilbertson, who was the founding CEO of BHP Billiton, and effectively he runs Pallinghurst, which has got 4 operating areas, and platinum is one of the largest operating areas. They've got a new platinum mine, Platinum, and they're breaking even at the moment. And as they continue growing, it's low cost, low-level mining. So what that means is that they have, over time, they have approximately between $500 and $600 dollars an ounce of competitive advantage relative to deep-level mining. So they'll take the current 120,000 ounces to 240,000 ounces over the next 18 months, and over the next 5 years to approximately 500,000 ounces. And we just think that's a wonderful position to be in, where you kind of effectively mining surface, and your competitors are having to go 1.5 kilometers underground. They're also just in the process, in fact, the first ore of the manganese mine in the Northern Cape has just gone and will be on the truck, shipped to Richards Bay or Port Elizabeth very shortly. So it's a brand new mine, again, open cast. And so we believe in South Africa, if you're going to be in mining, you actually have to be in open cast mining. And if you're going to be in platinum, you have to be in the open cast platinum mines, which should give you a competitive advantage and really add value. So in Pallinghurst, you've got manganese, you have iron ore. They've also got a business called Gemfields, which specializes in emeralds and rubies. Emeralds in Zambia and rubies just about to get off the ground in Mozambique. They've got Fabergé, which has been relaunched and gaining great momentum. And then an iron ore, open cast iron ore operation that is in its feasibility stage in Australia. So you're buying all of that with the greatest management, with a strong balance sheet, with lots of cash on balance sheet, and you're buying that at approximately 40 cents in the dollar, and that dollar is at depressed value. So it's one of those companies on a 10-year view, you could look back and very easily say that this could be up anything 10, 20, 30-fold, very much like when we bought Assor 10, 12 years ago.
Adam, I think no one doubts the deal-making skills of Brian Gilbertson, but there have been 1 or 2 concerns that the interests of the executive team with Arne Fransen were not perhaps aligned with shareholders. Do you agree with that statement, or are you happy that the interests of that executive team are aligned with shareholders?
I think we've put our money where our mouth is. We've increased our holding in Pallinghurst to approximately 15%. We have put approximately 500 to 600 million rand into the greater Pallinghurst Platinum operation. And we think over time that if we get a tenfold increase, that 500 million could easily go to 5 billion, and with a very reasonable probability over the next 5 to 7.5 years. We've spent a lot of time with the management team. We're fairly comfortable that they're working, and they're working for us, and they're working for all shareholders. So I think from a long-term perspective, they do get rewarded for performance, and we're very comfortable if they deliver that they share in the reward, and our shareholders and our clients would do very, very well backing this management team.
As you say, Adam, putting your money where your mouth is, but overall, when it comes to rand-sensitive stocks, rand-hedged stocks, so 53% of your portfolio is sitting with those stocks, half of them being assigned to companies that earn predominantly offshore, and then, of course, you've got the exporters where resources would fit into that category. Talk to us about some of those companies that you're looking to invest in right now that earn majority of their money offshore.
Okay, there's a combination of companies that earn their money offshore and those companies that export. So companies that earn their money offshore, we have a very big investment in a company called Reinet, which is the Rupert's global investment company, and it's currently trading at approximately 30% discount to net asset value. We think it's a well-diversified with BAT as a cornerstone in that portfolio, and over time we expect a huge value add from that Reinet. We have a big exposure to Mediclinic. Mediclinic has now got a footprint in 3 continents. It's South Africa, the Middle East, in the UAE, and Europe in Switzerland. We believe that healthcare is a high growth market, aging population, and a need from a younger population in the Middle East. So a company like Mediclinic, well positioned. We have an exporter called Omnia, which basically produces fertilizer and the explosives for open cast mining. And as if you think about it, corn prices are very, very high. There's a global drought, global shortage of corn. Prices will ensure that you have, over the next 5 to 10 years, greater demand than supply, so you're going to have more plantings, more use of fertilizer over the next 10 years. Secondly, they also produce the explosives that go into the open cast minings, so the more coal that Eskom needs, it needs to be blown and shipped to the power stations, the more iron ore that's needed. And we think that Omnia is a very, very great company. They reported forecast earnings up 50%, despite having a rights issue to fund a new plant that has just come on stream and is not yet contributing to profitability. So we're very excited about some of the rand-hedged shares in our portfolio, those that are offshore with a predominant offshore base, and those that are exporting globally, and also import replacements.
Adam, just to talk about the domestic side of the portfolio, if you could call it that, you have quite a fairly big holding, about 16% of the portfolio in consumer staples. Just for the benefit of our viewers, could you tell us what exactly you've been investing in there?
I'll use one share as an example, Rainbow Chicken. Rainbow Chicken at the moment is an out-of-favor company in an out-of-favor sector, mainly as a result of 2 things: high feed costs that we just spoke about in Omnia, and secondly, imports coming through from particularly Brazil. But if you think about it from a long-term perspective, poultry is the cheapest protein, and Rainbow is the market leader in that area. And when you go forward and think about it, the more the Chinese and the Indians consume protein over the next 5, 10, 15 years, the demand for protein, and therefore the demand-supply fundamentals in a company like Rainbow and the poultry industry globally is fantastic. So we've bought approximately 13% of Rainbow, and we believe that on a 5, 10, 15-year view, people need protein. Poultry is the lowest cost protein, and Rainbow is the market leader. So we think value add phenomenal in Rainbow over the next 10 years.
And of course, when you talk about being a value investor, I assume that when you look at the multiples on retailers right now, you're shying away from them. What are your views on the retailers? Do you have any holdings in that space? And what's your outlook for the retail space?
If we just wind back to 2001 and 2002, we were in a perfect storm. Everybody disliked retail. They were very, very cheap. The earnings were depressed. The valuations were depressed. So I'll give you an example. In round about 2001, 2002, we bought Mr. Price at approximately R3. Very depressed earnings, looked very, very attractive. And we bought most retailers in that sector. Come 2012, the earnings are now phenomenally high. The valuations are extremely high. And we think that the sectors must probably be between 30 and 50% overvalued. It looks most like a bubble. And when the foreigners move out of the sector, you could see that the major retailers like Mr. Price, the Foshinis, Truworths, Woolworths, they're executing phenomenally well, but it's fully priced and most probably significantly overpriced. So we sold out of those stocks over the last 6 months, 12 months or so.
Well, Adam, thank you so much for joining us. Some interesting insights into some of the companies that you've got holdings in. Adam Ebrahim, CEO of Oasis Asset Management, joining us there from our Cape Town studios. That's it for Investment 360.